Hi there, my name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com, and today I'm going to present to you 7 bear market mistakes and how to avoid them. Not too long ago, I feel like this bear market feels like it's lasted forever. I feel like we've aged a lot in the last couple months. But mid-February and late February, when things really started rolling over, immediately started leading me, and I know many others, to compare where we were at and the strength, the feeling of the sell-off relative to previous bear market cycles. And I immediately started to think back in my own experience going through some previous bear markets, and also talking to some mentors and friends that have been doing this longer than I have, just to learn from them as best as I can. And I came up with these 7 mistakes that I myself have made, and I find others tend to make. What I want to do is just articulate what they are and how to address each of them. And again, I think a good investor practices good self-awareness. They know that they are imperfect. They know that they are wired to make poor decisions at times, and they do what they can to try and minimize the impact of those poor decisions. So hopefully, this will help you avoid some of these mistakes. And if you see some of this in your own behavior, hopefully it can help you sort of tap the brakes and minimize their negative impact as quickly as possible. I just wanted to start with a chart of the S&P 500 with my own career history, so you could see how and when I've weathered some of these previous bear market cycles. And the reason why I'm doing it this way, we're actually in my previous role, one of my previous roles at a large buy-side institution. I was a hiring manager, and we were looking for a graphic designer for my team. And so I got hundreds of resumes, and I'm flipping through them the one afternoon. And all of a sudden I saw someone who had turned the top half of their front page, their resume, and had basically just put a big chart of the S&P 500 and had put bullet points along the chart illustrating their career history. And I thought, what a great way of visualizing for for a financial analyst. What a great way of visualizing where you've come from. And in the end, also talk about knowing your audience. What a great way to differentiate your resume. So in the end, we ended up hiring him. He did a great job for us. So I want to just walk you through very quickly where I've been for some of these previous bear cycles. So I actually started in New York at Bloomberg in mid 2000, in June of 2000. So my introduction to investing, and I knew very little about investing up until this moment. So my introduction to the financial markets and to stock picking and to the Fed and the economy and bonds and all of these different parts of the financial markets were basically during this the end of the great secular bull market of the 80s and 90s, the end of the biggest bull market in U.S. history, and the beginning of this huge unwind of the tech bubble. We also had 9/11 along the way. It was the beginning of a secular bear market that lasted over a decade. So I've often had, I wouldn't call myself a perma bear, but I often have more of a focus on the risk side of the equation than the reward side. And I think part of that is just formative years of learning technical analysis during a period when I saw the transition from euphoria to desperation. It happened very quickly. And so that is where I learned the technical toolkit. It was basically a way of managing the downside. So I was there until 2008 when I went to Fidelity, and I was a managing director of research at Fidelity from 2008 to 2016. So the beginning of my time up in Boston was dealing with another cyclical bear market cycle and seeing how money managers that I was working with and professional analysts that have been doing this for decades were dealing with another bear market, and one that undercut the lows from 2002, which didn't seem like it would ever be possible. And I remember around here in early 2009, I mean, we were wondering if the market was going to go to zero. And when you look back, it seems like a beautiful fire sale for good companies. And you think, wow, if only we could have bought at the low. But I will tell you, having been through some of these, it never feels good around this point. And I'll share with you some quotes that back that up. But anyone that's been through some of these bear market cycles, the time when it feels least likely to work is down here what ends up being the eventual low. It's much easier to see in the rearview mirror. I was president of the CMT Association here from 2010 to 2014. I launched my own research shop called Sierra Alpha Research here in end of 2017. And right about here, I was starting to feel pretty encouraged because it felt like this pattern I had of career changes, of job changes, and cyclical bear markets. It felt like I'd finally broken that, and that felt pretty good. The bad news for all of us is I actually joined StockCharts.com about 6 months ago, moved out to the Pacific Northwest here in Redmond, Washington, and have enjoyed greatly my time so far with my new colleagues here at StockCharts. And I thought again that the pattern was broken, but now it appears that we are back to the major job changes and cyclical downtrends. So I will remind all of you, the Dave Keller Premium Research Package involves, I will give you a heads up if I'm ever considering another career change, so you can, preemptively, get to cash or something. I'm totally joking, and I'm not planning on doing anything like that anytime soon. So these are some of the bear market cycles that I've been a part of. Some of them are bigger, more painful ones, like 2000 to 2002 to 3, 2007 to 2009. Other than short term and but equally as challenging, like the 9/11 stretch, 2010, 11, 15, 16, all of those. So let me go through each of the seven, what I call the bear market mistakes, and I'll go through each one of them, just explain what they are and hopefully how to avoid them. So number one is not validating the anecdotal with the evidential. You see, I would argue that markets are driven 100% by fear. When I learned technical analysis 20 some years ago, it was, markets are driven by fear and greed. Fear on the downside, greed on the upside. I would argue that that's now transitioned over the last 20 years to be more driven by fear all around. On the downside, it's fear of losing everything. On the upside, it's FOMO, it's fear of missing out. And that anxiety that comes with the unknowable future, I think is what causes investors to make decisions and motivates a lot of decisions, especially poor decisions. So, what you have to remember is that, the anecdotal evidence is palpable, and especially now when there's so much uncertainty with COVID-19 and with the economy and, job loss and furloughs and just how we're, now that this economic machine has been essentially put on pause in many ways, how do we restart it? And just the, the uncertainty of what all is happening around us. We don't really know what the future is going to hold. So I would remind you that, the problem with anecdotal evidence is that it's not quantifiable necessarily, and it's not testable. Evidence, price data is testable and is measurable and is quantifiable. So what I would encourage you to do is get away from pure anecdotal calls and into more evidential calls. And I will tell you as an example of, as the COVID-19 coronavirus sort of proliferated, here in the Seattle area, we actually learned about a lot more about it, I think, than others very early on, because the first U.S. cases were not far from here in Washington. And so we have been on lockdown for a while. We've had a lot of, sort of the early experience was here. And then since then, it's now, spread obviously across the U.S. and really across the world. But, we were sort of learning about it and dealing with it a little earlier. And, anecdotally, I remember as it was just starting here, I remember thinking, wow, if this would become more widespread, this spreads to like New York and California and major metropolitan areas, this is going to be hugely disruptive. And this was at a time when we really weren't sure. It was almost potentially as a non-issue, right? But I started to see how it changed the way of life locally and started to, make some assumptions about what could happen broadly. But again, that's all anecdotal evidence. That's all a guess. For me, you have to validate that with the evidence. So, I have trend following models that I've been following for years. This is an example of what that trend following model looks like. It's not completely up to date for today, but maybe a week old. But the essence of it is fine. This is right actually when the sell signal was triggered for the long-term trend following model. So I'm looking at a weekly chart of the S&P 500, the 21 and 34 week exponential moving averages, so very long-term. Then this is what I call the long-term trend, which is the difference between the 21 and 34 week exponential moving averages. So I use the PPO indicator, which is very similar to the MACD indicator, just looking at the difference between those two moving averages. So when it switches to below zero, that tells you it's switched more into a bearish trend. The last time that happened was in late 2018. Before that was back here in 2015 and 2016. What's funny is, ironically, happened in a big up week. This is a bullish engulfing week we had a couple of weeks ago. Since then, the week after was more distribution, and the model has remained in a negative stance through today. At the bottom is more of a short-term tactical model. It's actually turned negative in mid-February after that initial sell-off. This is based on the weekly PPO or the weekly MACD using the traditional settings. So for me, the anecdotal evidence of, wow, I'm seeing what's happening around me locally, I could imagine how this could become worse, and I can think about how that's going to impact stocks. I bucket that with things like a lot of sentiment indicators, especially survey data like the AAII rankings, also magazine covers, things that give you a sense of social mood and the changes in euphoria to desperation and back and forth are all very important, but I would say they're anecdotal. What you need to do is think about how to validate what you're seeing. Don't ignore those things, pay attention to them, but then validate them with rock solid evidence. And again, you can't restate the price. The price happened. So use the price as a way of validating whether or not things are playing out in the way that you might expect. So that anecdotal evidence puts it on your radar. The charts are what should validate what you've heard with the anecdotal evidence. So that's mistake number one, is you pay too much attention to anecdotal evidence, what you feel about things, instead of the evidence. And I would say a bear market cycle is a really good time to do that. Mistake number two is embracing the endowment effect. And as an example, this is one of the coffee mugs that I have in my office here. I've used it many mornings recently. And this is a particular mug that I've owned for a couple of years. Let's say that, you came upon this mug, I gave it to you or something. This mug might not mean a lot to you because you don't really know what it is. The Walden School may not mean much to you. And you think, well, if you broke it or if you lost it or something, it wouldn't be that big a deal. You just get another coffee mug. So it doesn't mean a lot more to you than just it's a coffee mug, right? It's a way to hold coffee. For me, though, it means actually something very particular, because this is from a music conference that I attended a couple years ago. And it was a transformative experience where I was able to compose and arrange and work with other musicians. It was a beautiful musical release for me. And so for me, this mug is actually incredibly special because it takes me back to that experience, that week-long experience up in the mountains of New Hampshire composing music. So for me, this actually has much more meaning than it does for you. And I've now introduced you to the endowment effect. Something that you own, something that you hold, that you possess, has greater meaning than it does for others based on the fact that it's what you own. And I think with stocks, we get that a lot, right? When you own a stock, something like Disney, it's in your portfolio, you attribute greater value to it simply because it's one of your holdings, as opposed to looking at in an emotionless way at the data. So let's say you own Disney right around here and you're feeling pretty smart because in late November it was going to new highs here for the last year. Then it started to roll over. And between there and late February, a number of things happened. A number of warning signals. Number one, you broke below the 200-day moving average. You broke below price support from last fall. The RSI got out of the bullish range and was in more of the bearish range, getting oversold and not getting above 60 in a couple of bounces off the lows. The relative strength was going down, and year to date, it's just been a consistent underperformer, even since late November of last year. So again, even though, before it went from 120, 130 down to 80, there were plenty of warning signals along the way telling you at least you should take some off the table, right? You should maybe reconsider that as a core position for yourself. What happens though, the endowment effect forces us or compels us to hold on to a losing position like this as it goes lower, as it loses value. So what you need to do is don't think of it as your current holding, something that's special. Just look at it with fresh eyes. I would always tell people, imagine you had new money right now. Would you put it in this stock? And if the answer is no, then why would you have old money there? Mistake number three is an over-reliance on analogs. So I've found what a lot of people do is they look at this particular chart and they compare it to previous bull or bear cycles, right? How does this sell-off relate to some of these other sell-offs going back? And I would say, analogs are interesting, but again, I think of them more as anecdotal evidence. So looking at what we've done relative to 2008 is interesting. Relative to 2001, that's all interesting. But remember, when you're comparing right now to one other point in time, it is if you told a statistician that's what you're doing, comparing one observation to another one and drawing any conclusion, they would laugh you out of the conversation, right? Because from a statistical perspective, there's absolutely no evidence that you could draw out of that has any statistical significance, because you're just comparing two observations, right? What are the reasons why, or how can you make that assumption that they would be the same, that they would be identical? So I would say if you rely too much on an analog, and I've seen a lot of comparisons of this is how this bear market was, and here's where we're at if you follow that playbook, I think that's dangerous if you assume it's going to be a one-to-one. It's going to be a perfect correlation between those two. However, the markets tend to rhyme. So I think using historical bear market cycles as a learning experience, think about what conditions were like, how things happened, can be interesting. But what I would hope it does is lead you to ask further questions. How can you further analyze where we're at? So instead of focusing on what happened before and assuming the same thing is going to happen now, look at the current market environment and use the toolkit that you have. Look at things like bullish and bearish divergences for validation. Look at where the market performs relative to key support and resistance levels? Is it able to reclaim resistance, break above Fibonacci levels, break above historical supply areas or demand areas? That's what should validate that the market is evolving, not here's what happened before and I need to assume that they're the same. So don't over rely on analogs. Use them anecdotally as a way to fuel the questions you want to ask about the current market environment. Mistake number 4 is getting sucked in by bear market rallies. And I think the last couple of weeks, we've already had a couple of these feelings where, if you look back at 1929 to 1932, which is sort of this first half of this chart here, this looks like a very consistent downtrend from the peak in 1929 to the bottom in 1932. But if you look, a couple of these times we retraced 30, 40, even 50% of the previous down leg. So here in 1930, it felt pretty good probably, right? We broke above the previous high, probably felt like we're actually, regaining some positive momentum. You're thinking, all right, that wasn't that bad. I guess we're going to get on from here. And if you look, there was huge destruction of wealth for the next couple of years, right? There's not a short-term thing. Bear markets tend to be a process. They don't tend to be a moment. So the problem with bear market cycles is you will have these rallies. And for me, I'm thinking back to the rally after 9/11. Once the markets opened again, we sort of stabilized, and then, it sort of started to come up a little bit. And I remember thinking, oh, okay, well, I guess, that was the bottom. We kind of put it in. But then, of course, we rolled over and moved to further lows until the eventual 2002 low that was established. But, again, during bear market cycles, you will have quick, even sudden, what feels like incredible positive momentum coming out of these lows. And you will have, even in the last couple of weeks, we've had days that have spiked 7, 8, 9, 10+%, and on sectors even more than that. So the danger is, if you have a long-term time frame, getting sucked into some of those bear market rallies. They will be sudden, they will be quick, but I would be looking more at long-term charts to maintain a proper perspective on what the long-term trend really is. 2 quotes to help illustrate that point. Number 1 is Bob Farrell, who ran the Merrill Lynch technical team in the 70s, 80s, into the 90s. He said at the bottom, stocks will be cheap and no one will care. Walter Deemer, who ran the technical team at Putnam in the 1970s and 80s, so he was there in the 1974 market low, said when the time comes to buy, you won't want to. The consistent theme between both of those is there is a negativity that, when the bear market finally ends, no one could imagine, or the average person could not imagine wanting to buy a stock because it just seems so ridiculous because the market's so bad. That's when you want to buy, right? It's not, if you find yourself too quickly trying to find the bottom and trying to jump in, that might be an anecdotal signal that the bottom is not yet in place. The 5th mistake is forgetting your time frame. This is looking last week at 5 trading days, Monday through Friday, and it's just to illustrate, what I find a lot of longer term investors make the mistake of making long-term decisions based on short-term price movements. If you watch my show on StockCharts TV, The Final Bar, which is our closing bell show, runs at 6 p.m. Eastern these days. We talk a lot about the short-term movements of the day, but then connecting it to the long-term trends. And it's all about understanding the long-term momentum in the markets and making sure you're on the right side of things more than you're not. One of the mistakes I see people make is looking at the short-term fluctuations, especially thinking of mistake number 4, some of those bear market rallies, those quick rallies, counter trend rallies within a longer term downtrend. You start making long-term assumptions based on one trading day. And I would always remind you, don't get too caught up in the flickering ticks of the short-term movements. Always look at the longer-term charts. This is the time to be looking at daily, then weekly, even monthly, quarterly charts, and understanding the long-term trajectory and where this day, this week, this minute fits into the bigger picture. So this is a reminder. This is the S&P 500 going back to the mid-1920s. The encouraging part about this, hopefully, is if you look back in history with 100% accuracy, every bear market cycle has indeed been followed by a bull market. So that's good. That is, the odds are in our favor that a bull market will resume at some point in the future. But whether that happens today or next week or next month or next year, I don't know, and it's not something that is knowable. I would point out that a lot of these moves that seem very orderly and it seems like a quick, a break before the continuation of the uptrend, some of these are career-busting moves along the way here. So the short-term movements in the market certainly have their consequences, but it does help, especially if you have a long enough runway, to remember that there's plenty of opportunity for further gains in the value of equities going forward. Mistake number 6 is getting too married to a narrative. There's a thing called narrative bias where you get caught into a particular narrative, a particular story, a particular theme, a particular relationship. One that I've heard thrown around a lot recently is the relationship of stocks and crude oil. And it's been said, if you look back and just visually, if you look at the S&P 500 here in blue, you look at crude oil here in black, you'll notice that in general, they certainly seem to appear to move in consequence, right? They move together. So when stocks are doing well, oil has done well. And if you look, it seems like a pretty good marriage of the two. The kicker is, though, sometimes it is and sometimes it isn't. At the bottom, I'm looking at the rolling 20-bar correlation, looking at the daily price data on the top, and you can see over time there are plenty of times when it's been strongly positively correlated, but there are other times when they're uncorrelated or even strongly negatively correlated, like here in mid-2017. So there's no guarantee that that relationship, one-on-one relationship, is going to continue. So I think the point of mistake number 6, getting married to a particular narrative, is you can't really draw too many conclusions between two assets, right? This stock does X, or the yield curve does X, or gold does the blank, so this other asset should do Y, right? Bonds are doing this, so that means this stock should do whatever. Because you have to remember, those things never happen in a vacuum. It's not like there are two variables and you can analyze those two and that's it. There are literally thousands, if not millions, of variables that are driving asset prices at any given moment. And we are in the middle of all of that, interrelationship, that interplay of all those different things. So to put another way, the equity and the markets are not a simple system. They are a complex system, right, with lots of different variables. So this is a chart looking at major asset classes, currencies, commodities, interest rates, or bonds and stocks. And you have to find, as you look back, there are times when they move together, there are times when they don't. And those relationships are fluid. As much as I wish they were consistent and 100% straightforward over multiple timeframes and multiple regimes, they change and they're fluid. And having an awareness of the different themes and how they're evolving, I would say, is going to help you not become too connected to a particular narrative. That brings me to mistake number 7, which is overestimating your performance and process. This is a chart of Home Depot going through sort of late March, and looking back, if you look at this, there are clear signals that the stock broke down, and there are clear signals that the stock has bottomed out. And if you held Home Depot here in mid-February as it broke to new highs in the third week, and then started to roll over, probably along the way here. And again, I'm just thinking on average, generalizing. There are some ways maybe that you saw technical reasons why we should sell it. The chart of Disney we saw earlier, very similar, right? We broke down through support, we broke down through the moving averages, the RSI broke down, the relative strength rolled over, all these things. So there may have been a time when you would have sold, would have bought during that period. And maybe if you did hold this stock over that time, you had your own experience with that. But this is what's going to happen. In rear view mirror, we call this hindsight bias. You will optimize your own memory of your performance over a period of time. So the further that we get from February and March of 2020, you will start convincing yourself, and you will believe it so deeply, you will absolutely think it's the case that you called the top and you top ticked it, you sold right at the top, and then you got in right at the bottom. Even though that might not be exactly what happened, your brain actually convinces that. And it's a way that we adapt to negative experiences. We convince ourselves that things weren't as bad, and we sort of optimize. We upgrade our own performance in the rearview mirror, again, called hindsight bias. So it's okay. What you need to do, though, is be wary of that, to recognize that your own memory of your investment performance is not going to be perfect. So how do you fight that? You have to write things down. You have to capture your thinking. I have found written journals are very good for this. I would argue even more so. Using the charts not as a painting, but as a workbook. Use your charts on StockCharts as a notebook. Put in comments, just like I did here. Put in comments right on the chart. Save them into a chart list with your portfolio and save your thinking at different points. Put on the chart exactly why you bought or sold things at a certain point. Then you can look back on the chart and see exactly what happened leading up to, coming after your decisions, and then make a much better practice of understanding, learning from some of those mistakes. So here is now, now that you've learned the 7 bear market mistakes, I'm now restating them in more of a positive, more positive language to explain my bear market playbook. Number one, validate the anecdotal with the evidential. Don't rely too much on your anecdotal feeling, but use it as a way to fuel the evidence you want to dig into further. Number two, set stops and sell when you need to. Resist the endowment effect. Treat stocks as something that you rent, not that you own. You're not tied to them. You can always cut losses if you need. Number three, view analogs as descriptive, not prescriptive. Analogs help you understand how a current market relates to something else, but it is not a one-on-one comparison. There's no guarantee that the current market is going to line up to any other previous period, and that it is going to continue going forward from this moment on. So use those as a way to describe what has happened and describe what is happening, but use actual evidence, price data to prescribe what you think is going to happen next. Number four, avoid the temptation of bear market rallies. They will suck you in. It will be very tempting. Pay attention to the long-term trend. Number five, remember your time frame. Don't get too caught up in the short term. Remember the long-term trends and how they evolve. Number six, focus on the charts, not the narrative. The best way to fight narrative bias and disconnect from that is use the charts, analyze what you're seeing, and draw conclusions from the price data itself. And finally, number seven, use a journal. Use the charts as a notebook and learn from your wins and losses. Take time after this is over and after we've recovered from this bear market phase to learn from how you handled it using your actual trades. Don't rely on your own memory of how well you did. I actually uploaded this presentation. I hope you found this interesting. If you go to my website, marketmisbehavior.com/7mistakes, you can download a PDF version of the presentation I just gave. And again, hopefully you can learn from my bear market mistakes and hopefully not recreate them in your own investing, but find ways to minimize the chance of you doing so. And also, I just remind you, I host the Closing Bell Show on StockCharts TV every weekday, 6 p.m. Eastern, 3 o'clock Pacific. We'll go through the charts together and apply many of these lessons in the playbook to the current market environment every single day. And finally, if you can read the tickers on the final slide, you get my last message, which is thank you. Appreciate you watching StockCharts TV. Hope you found this helpful. Look forward to engaging with you in the future. Thanks a lot. This is Dave Keller saying, be well, be safe. Bye now.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.